we've been in a bull market for a long period of time now, actually since about 2009. Who in their own words could tell me what a bull market is? What's a bull market, guys? Yeah, come on. What's the market doing right now? It's growing. And so if we have a bull is characterized by the horns. It charges, it moves. If we have a bear, what do bears do this time of year? They hibernate, man. They hunker down for the long haul. So we're in a bull market, which means it's very exciting for us to look at the market. So in this chapter, you're going to learn how the stock market works. And we're going to actually play with some virtual money. What I'm going to ask you to start thinking about, guys, we're going to be putting together groups of 4 to 5, and you guys are going to be playing the markets together. On Monday, we're actually going to name our groups, and you guys will be working together on this project. So yes, we have a group project in this class. Start thinking today about who you want to work with, because a large percentage of your final grade is dependent on this particular project. So we're going to be actually writing those group names down on Monday. Start thinking about those today. Monday, we're actually going to cover the stock game. If you remember, test 1 is going to be next Wednesday. By show of hands here, who all has Lockdown Browser installed on their computers? All right. Anybody who does not, hit me up. I'll help you out. So, guys, one more time. By show of hands, who has it installed? All right. Leroy, if you would, man, download it, install it in class. You have my permission. You got it. I didn't see your hand up. I'm sorry.
I'm installing it now.
Okay, excellent. Guys, to move on, next week we have a little unusual schedule because we're going to be taking our first test in this class next Wednesday. Next Friday, Career Services is going to be running the class. They're going to be coming in with some more applications that are going to help you guys hopefully network and find jobs. Your next assignment after that's not going to be due until after break. That's going to be your rate of return assignment. We're going to have a small Career Services assignment that's due before break. You're going to have a rate of return assignment that's due after break. We're going to cover that in class. You're going to know how to do it. Your next big assignment then is going to be on April 6th when you're putting together your entire stock game submissions. Fear not, we're going to cover this in class on Monday. So guys, just so you also know, because where we're at in the mid-semester, because your stock game is a substantial part of your final grade and it won't be done by the time I have to file midterm grades, 60% of your midterm grade is going to be based on our first test. 40% is based on homework. So if you screwed up on the homework so far, you can still make it right by doing well on that test. The test is 50 questions, multiple choice, true and false, with a couple of bonus questions. Plus, if you have any bonus points coming from the events that we had up till now, I'll be adding those on. It's 40% homework, 60% tests. Now, when we get to your final grade, I still weigh tests heavily. We have 60%, but 20% of your final grade is going to be based on the stock game. Any questions so far, guys? All makes sense? All right, well, guys, we're starting off today because it's a retail holiday. I would like you to direct your attention to the screen. We're going to do a little video on the history of Valentine's Day, why we celebrate Valentine's Day. In fact, the big things that we associate with Valentine's Day. Obviously, the average cost for a dozen roses delivered today in 2020 is right around $100. So if you're spending money on your loved one today, it's going to be a little bit more than normal periods in time. The other things that also go on with this stuff, guys, greeting card companies make some serious bank on Valentine's Day as well. And the changing nature of our economy is actually hitting these companies pretty hard. Why are greeting cards not as big of a deal as they used to be? Why are people spending less money on this stuff? Yes? Everything's digital, man. You can send somebody a text message and say, hey, I'm thinking about you today. You can send them an online greeting card. We do social media posts. So these companies definitely still rely on these holidays to get people interested about this kind of stuff. Guys, we're going to jump right in, however, and we're going to jump into Chapter 19, which is all about securities. Guys, write this down or take notes on this fact. If I say we're talking about securities, the word security doesn't mean I feel safe in this context. Security means stocks and bonds, things you can invest in. So we're talking about securities, we're talking about stocks and bonds, and we're talking about the stock market. Guys, if I had $100,000 in cash right now, and I could give you $100 grand that you didn't have to earn, it just landed on your desk, what would you do with it? Who said that? How would you invest? What kind of investment would you get into? You know what's funny? Some of the most successful clothing lines in the world have started with far less money. Have you ever heard of the story? There was a brand that was big in the 90s and early 2Ks called FUBU. Have you ever heard of it? FUBU. Yes. Do you know how he started his business? He started buying T-shirts from other places, from other stores, and putting his own logo on them and selling them on street corners. He literally was selling shirts out of a bag on street corners and built a multi-million-dollar brand with next to no investment. He was doing this stuff out of his house because he knew how to really position and market. Good stuff. What would the rest of you do if you had $100,000 just to do whatever you wanted with? What would you do with it? Pay your tuition. Get rid of that debt. I feel you, man. I'd pay my student debt off too. What else would you guys do with $100,000? I need to hear from somebody over here. What would you do? Oh, where would you go? You could spend a pretty big chunk of change on that vacation too. Is there anybody else you'd say, to heck with it, I'm just going to blow it? What would you do?
I don't know what I'd do. Probably spend it on stupid stuff.
Stupid stuff. Like, give me an example.
Video games.
Video games. Yeah, you can buy a lot of video games for $100,000.
I'd make a nice gaming room out of that.
That would be pretty sweet. I'd have a home theater too. I think I'd take $20,000 and just have some fun, and the other $80K I would invest in this market in particular. Let me give you an example of how good this market is, guys. When Planet Fitness 2 years ago went public, anybody have any idea what their stock was trading for? It was about $27 a share during the initial public offering. You know what that stock was going for yesterday? About $84 a share. Just imagine if you had $10,000 to invest in that stock. You could be selling that for a large chunk of change today. People who knew how to play the markets, who bought Apple in the 80s and 90s when the stock was worth nothing, are making serious bank now. That's what the markets are all about. How do we grow our money, guys? The stock game, what we're going to be doing, well, you're going to be breaking into groups of 3 or 4 to 5 individuals, and you guys are going to be playing $100,000 in the markets. You're going to be saying, what can we do to grow our money? We have different investment strategies. How many people in this room consider themselves to be risk takers? So we've got some folks who are comfortable with risk. How many people consider themselves to be a little more conservative in their investment strategy? How many people are unsure? It's okay. It's okay to do both. We refer to a diverse portfolio. That means we're doing some things that are high risk. We're doing some things that are sure things. So we're going to talk about what stocks and what investments are lower risk than others. What this chapter is all about is getting you involved in knowing how the markets work. So by the close of class Monday, and you're free to discuss this outside of this class, I want you to email me your stock group's name. So somebody in the group is going to email me the name of the group, and you're going to carve in all 4 or 5 people who are listed. So if you've got 5 people in your group, you're going to carve in everybody. Yes.
You got to choose our group.
You got to choose your groups. Yep. You guys pick your own people. Now, guys, here's what I'll say about it. The biggest mistake I see that gets made in class is when people always go with the folks that they normally hang out with. Go for the folks who are going to make a good group. If you know somebody's a good writer, grab them. If you know somebody's good with math, grab them. Anybody here actually played in the markets at all yet? I would grab the folks who just put their hands up because they already know how the markets work or are involved in the markets. So think about that stuff. So by the end of class on Monday, everybody in here should be in a group. That's number 1. And number 2, you're going to email me your group. You're going to email all your partners so they're carving on the email, and you're going to give your group a creative name for playing the market. So remember that. I'll announce it again on Monday. What we're going to be talking about in this chapter, I'm not going to read this to you, but to say basically we're going to get in from the very get-go what stocks and bonds, what securities are all about, and we're going to get into why you should know about the market, how you can play the market, ways you can invest, ways you can grow your money. A little disclaimer, this is not a finance class, so if anybody is, do I have any finance majors in here, by the way? All right, when you guys are getting into a class as basic as Finance 201, or Finance 202, I should say, that's going to be more complicated than what we're going to cover today. We're going to be covering the markets as a whole. So this does not constitute finance or financial advice. But securities, guys, basically mean we have ways of investing in companies and growing our money. There's two benefits to it. If you're a business, what's a benefit of you going public and issuing stock? How's that good for you as a business? Anybody have an idea? Why do companies go public? Why would you want to have people buy a part of your company? Wow, no guesses on this. Guys, what happens when we go public? We issue stock, which means people can buy shares of our company, which means we can make a lot of money really quickly. Because if people are buying shares of our stock, we have that money to do whatever we want with within the limits of the law. The other part of it is the other benefit to us is I don't have the money to go up to Jeff Bezos and say, hey, I've got $100 million to invest in Amazon, but I can buy a share of stock for $1,600. So I can play the markets too, even as a small fry, and I can make money. Guys, here's the trick. How many of you have ever heard your parents, by show of hands, how many of you have ever heard your parents talk about their retirement? Yeah. Guys, here's the trick. Almost all of us have our retirement tied into the markets. So when the market does well, my retirement is doing well. Toby, I have a question for you, man. Is Social Security going to be around by the time you retire? So we're counting on the markets, right? We're counting on the markets. If you have a 401k, you're playing the markets. That's how private investors are able to get in and play. That's what this is all about, guys. So we have two types of markets. We're starting to talk about securities markets. Again, securities equal stocks or bonds. You have what we refer to as primary markets, and you have secondary markets. A primary market means you're buying directly. A primary market, guys, what's a primary market? A primary market means you're buying direct from the source. A primary market means when we have an initial public offering, when a company's issuing stock, we can buy right from the company. Write this down. The IPO, the initial public offering, is the one time. Write this down. Write this down. The one time you can buy directly from a company is an initial public offering. Every other time, after that IPO is over, you have to buy from a secondary market, which means you're buying from a stockbroker. So if you want to get in on an IPO, usually the stocks that are hot start at a lower price and they accelerate in price. You want to get in on the IPO. So in terms of common speak, guys, in terms of securities markets, they help us as investors to grow our money. They help companies to make money, to expand and grow. Those are the two biggest reasons we get involved in the markets. So we also have people who are called investment bankers. And those are the folks who are helping us buy new securities. They're helping us buy stocks or bonds. So whether or not you're using an online app, for example, if you're using your Chase app or if you're using something like E-Trade or Ameritrade or whatever, that's technically an investment banker. And then you also get into institutional investors. Your retirement fund is what we refer to as an institutional investment. For example, I work at St. Francis. My retirement is managed through a group called Tia Craft. They pull all the investors' money and they invest it in multiple stocks to try to grow everybody's money. That's an institutional investor. When I'm buying stocks on my own, I'm dealing with an investment banker or stockbroker. When I'm dealing with my retirement, I'm buying from an institutional investor. So where can we buy stocks? We buy stocks from exchanges. Guys, anybody here ever seen a movie like The Wolf of Wall Street? Who here has seen that movie? Yeah, what does the stock market seem like when you see that movie? How would you describe it? Other than fast and dirty, how would you describe it?
Mischievous.
Mischievous. Tell me more.
He was selling the little stocks and making a lot of money off of it.
Damn straight. And that's what they also referred to that era right before the big crash in the 1980s. They were also dealing with junk bonds as well. When we see images of the stock market, people trading, what's it like? When you picture the stock market, the stock exchange, what do you picture? What images come to your mind? I know it's Friday, guys. I'm trying hard here. Have some more candy. What comes to mind? Is it a calm place or is it a chaotic place? Yeah. It's chaotic. There's people running around with two phones yelling buy or sell or all these things. That doesn't even exist anymore, guys. If you go on the New York trip to the stock exchange, it's a calm, quiet place because almost all that stuff is digital at this point in time. It's mostly symbolic. Stock exchanges still exist, but they are mostly digital. The largest in the world, write this down. The largest stock exchange is still the New York Stock Exchange, but other places such as Tokyo and London are pretty darn close. Over the counter, if you've seen The Wolf of Wall Street, over the counter stocks are stocks that are not listed on exchanges. In other words, people just have to know about it. They tend to be riskier investments. And if you've seen The Wolf of Wall Street, those people making phone calls to try to pitch these high-risk stocks and investments, that's over-the-counter stuff. That's what we're talking about. And finally, the electronic stock market happened in the first place because of something called the NASDAQ. And that basically was the first electronic stock exchange. Write that down too. It was the first electronic stock exchange, the NASDAQ. Here's what's ironic. They actually make the computers and the networks that make the stock exchange happen. And they're also a publicly traded stock. So you can buy stock in the company that powers the stock exchange. Pretty crazy when we think about it. So this is some of the stuff that's the underpinnings. If we get into the idea of what stock exchanges used to look like, what we're looking at on the left here, this is what the 1980s looked like, man. Crazy people jacked up on cocaine who were up on 4-day benders doing trades. If you see it in the movies from the 1980s, it's pretty darn accurate. This is a busy day on Wall Street right now, too, because it's all done on computers. Again, if you get a chance to go there, I wouldn't be surprised in the near term, next 10 years, that the exchange itself, physically, the exchange goes away because it's kind of symbolic. And once the old timers who are still doing manual trades are out of there, it's probably not going to be the same. So what are the top stock exchanges? Again, New York is still number one. Then we get into NASDAQ, London, Tokyo, and now Shanghai, because we got Shanghai, the Chinese, experimenting with a free and open market. So how do we deal with this stuff, guys? What happened in 2008, and how does it tie into the markets? From this side of the room, what happened in 2008 to the American economy that affected everybody else in the world? What happened? Dave, go ahead.
It crashed.
It crashed. What happened?
Thanks for giving out so many loans to people who shouldn't have done loans.
Yeah. Exactly correct. Excellent example. So the way it happened, guys, is I think I illustrated this before, but it makes sense because we're talking about the markets. We had all these banks that were giving out money and loans to anybody who wanted them so they could buy homes. People who couldn't afford them. They were getting into big houses and they were over their heads in debt. All of a sudden, when these people could no longer pay for their mortgage on this house and they weren't paying the bank could foreclose on the home. But if nobody else can afford to buy it, what do you have? You have sunk costs. You have something you can't unload, which is why we have entire neighborhoods in Detroit that are basically full of empty homes. As a result, this bank is not investing in the markets, and the markets slowed down too. So the Securities and Exchange Commission is the group that regulates this stuff. And they were created in the shadow of the Great Depression to say, we got to have rules. We got to have people who can come in and audit and make sure people should be getting loans so that we can keep the investment, we can keep the economy moving. As a result of that act in 1934, every company that wants to issue stock has to file something called a prospectus. Guys, raise your hand if you've even heard of that term before, prospectus. If you've not heard of that term, what a prospectus means, guys, is you're giving the SEC some indication of how solvent your company is, how financially set you are. Do you feel that you're going to be able to make it in the long run? A very famous company that's been in the news a lot lately for their electric cars recently, in the last couple of days, announced that they are going to issue more shares of stock. Who am I talking about? Tesla. Why do some investors get cold feet because of this? What they're asking is, if Tesla's doing so well, why do they need more money? Why do they need another several $1 billion of investment? It's making people scared and skittish about where Tesla is heading. So again, when you follow stuff with the SEC, it can be very, very jarring to investors. Because we've got foreign stock exchanges, guys, you're not limited to investing in the United States. You can invest anywhere in the globe, guys. You can go anywhere and invest. You can go in the Hang Seng if you want to get into Hong Kong. You can go into the London Stock Exchange. Now we're going to talk about stocks, guys. All right. We know if you issue stock, you're allowing people to buy a part of your company. When we buy stocks, what do we call it? You buy a piece of stock, it's It's a share. So you literally are part owner of a company. It's funny because I play in small stocks. I buy ones and twos because I enjoy playing in the markets. I literally right now own 2 shares of Planet Fitness. And part of me wants to walk into Planet Fitness with my stock certificate and ask them to show me around as a part owner. And it's like, the guy working the desk has never found the humor in that at all. But the bottom line is I do. I own part of Planet Fitness. So when you own stocks, you can also get dividends. What that means, guys, is if I bought that stock at $28 a share and it's trading for 86 cents or $86 a share, they can choose to give me part of the profits back as a dividend. Here's a thing to remember. I need you to write this down. Companies are not required to pay dividends. You can have a stock that is going gangbusters, man. You can be making money like it's going out of style, and you still don't have to get a dividend. Now, here's the trick. Let's say, for example, up here, we're the board of directors, this front row, and we're the board of directors for this company. And you guys are our shareholders. We had a bang-up year last year. We made, what percentage of profit did we make? We had a great year. What do you think?
80.
Yeah, our stock increased by 80%. And we're telling you guys, the shareholders, I don't think we're going to pay you guys a dividend. How are you going to feel about that? You guys are not going to be happy. And as a result, because you guys are the shareholders, you have votes. You can decide if we keep our jobs on the board of directors or not. So that's the power you have as a shareholder to dictate what your company does and does not do. But stock, you're not required to pay a dividend. Well, here's some of the advantages, guys. If you're a company, because we're a publicly traded company, we issued stock and we were able to get all this operating capital back from you guys to expand the company. I have no legal requirement. We have no legal requirement to pay you guys dividends. And it makes our company look good on paper because we had a massive influx of cash. Those are all the advantages. From this side of the room, guys, is there a disadvantage? I'll give you a hint. I just told you what it might be. What might be a disadvantage of a company issuing stock? Any guesses? Guys, from this side of the room, who controls the company? Is it the board of directors or is it the shareholders? Who controls the company? Take a guess. I promise no electric shock will be issued. In fact, if you make a guess, somebody's willing to make a guess, I'll hand deliver a candy to you. Oh, please, guys. Hook a brother up. Yes. It is the shareholders, and you should have another piece of chocolate for being that cool to answer the question. The shareholders can vote our asses out if they don't like the way we're running the company. In addition, you guys speak with your vote if you like what we're doing or not. If we say, for example, our company, say we're petroleum, and we say we want to start drilling in the Arctic, and you guys are green environmentalists who hold shares in an oil company and you decide you don't like what we're doing, you can vote us out. So those are the disadvantages. Here's some of the other disadvantages, guys. When you get dividends, you have to pay taxes on them. You get taxed twice if you're a publicly traded company. You get taxed on your profits, and you get taxed on the money you're making from stocks. And you're also hamstrung because you got to make decisions that are making your shareholders happy. Guys, there are 2 kinds of stock, primarily common and preferred. Which sounds better? This side of the room, which sounds better, common or preferred? Yeah, it sounds great, doesn't it? Like, we don't have that common stock like everybody else. We have the fancy kind. We got preferred stock. It's actually a bit of a misnomer. Common stock, although it sounds bad, means you have voting rights. Preferred stock means you give up your voting rights in exchange for getting dividends paid first. So, for example, please put your phones away, guys. You're in class. If we are paying dividends on stock, if your primary goal is to get paid, you may want common stock or preferred stock. If you want to have power in the company, you want common stock. Every share of stock you have is a vote, which means in this room, if I own 5 shares of stock and you guys own 200, you have more votes than I do, and you can control what happens in that company. Now, we can also have different kinds of preferred stock. Callable actually pays more into bonds, but convertible stocks mean we can convert the stocks at any time into common stock. We can exchange our preference for profit to actually have a vote. Cumulative simply means the more stock you accumulate, the more power you have in a company. Guys, I'm going to explain to you why this whole publicly traded thing is so important. By show of hands, how many of you are music fans? All right, guys, check this out. Most of the biggest selling artists of the last 50 years worked for record companies that were owned by individuals, not corporations. We go back to Atlantic Records, one of the biggest record companies in the 1970s and 80s. Groups that came out of there include people like Led Zeppelin and Leonard Skinner. Whether or not you like those bands, they made a lot of money. Their first records were not hits. So the record company believed in them and they invested in them until they made a hit. Who here has ever heard of Darius Rucker or Hootie and the Blowfish? Hootie and the Blowfish, their first album went gold multiple times. It was a massive success. Their second album only sold about half as much as their first album, but it still went gold. They made some serious bank on that record. The record company dumped them, saying it wasn't a good investment, and their shareholders were nervous that they weren't going to continue having hit records. So the stockholders actually controlled the music business. So the art that we enjoy and the music business that we enjoy as well is affected now by public investment because most of these entertainment companies are publicly held. That's what affects us. So anyway, guys, if you remember these two terms, you'll be fine. Common stock means you get voting rights. Preferred means you give up your voting rights to get your dividends paid first. That's actually a cologne they used to sell in the 1980s. That's how obsessed with money we were in the 1980s. It was preferred stock cologne. So, guys, before we do a recap of some of these key terms, I've been going pretty hard and fast today, so I would like a question or comment from somewhere in the room. You know, I offered to take her out to dinner, and she said, you know what, I'd rather stay home and cook for you. So she bought me candy to give to you guys, and now she's cooking for me tonight. I might be the luckiest man on earth, seriously. So I got a face made for radio, and I still got married. It worked out. So it's an excellent question. What are you doing for Valentine's Day?
Chilling in my house.
Good for you, man. Netflix and chill. Over here today, guys. Who has?
Speaking of Netflix, did you watch Don't F with Cats?
I'm sorry.
Don't F with Cats.
I have it on my queue. Have you watched it yet?
Yes.
Is it worth it?
Yes.
Okay. I haven't. See, here's the other thing. Here's the good side of marriage and there's the downside of marriage. The good side of marriage is candy and getting dinner made for you and having the love of your life. The downside is you don't always get control of the TV. And
Crazy.
yeah, and so sometimes you got to watch what your wife wants to watch. So you make compromises. But who else has seen that show, Don't F with Cats? Wow, not anybody. I still want to check it out. I get some TV time, that's on my list. All right, guys, we're going to continue. Guys, in terms of markets, again, just to recap, primary markets are the ones who sell new securities. You can only buy from a company, their IPO, one time. After that, everything is secondary market. So think about it like this. If you buy a Subaru directly from Subaru as a brand new car, Subaru and the dealership make money. If you buy it from a used car lot, the used car lot and that individual makes money, not Subaru as a corporation. It's the same deal. Guys, let's talk about bonds. Bonds are a little bit of an opposite kind of perspective from stocks. If you have a bond, it means you're borrowing money. Think of the B word, bond, borrow. So if a company issues a bond, they're basically saying, look, guys, we would like to borrow money from you guys. Now, when you borrow money from the bank and you pay it back, what do you have to pay it back with? Interest. It's a legal requirement. So the bond is basically, the certificate is basically saying that you have lent money to this company or individual. The principal means what's it worth on paper. So if I'm lending you $10,000, the principal of the bond is $10,000. The maturity date means when does that bond have to be paid back by, and what interest rate are we going to pay it back at? It all sounds pretty straightforward because it is, and there are lots of advantages to doing it. Some of you may have U.S. government bonds, which is considered to be very secure. Anytime the markets are doing well, guys, anytime the markets are doing well, people tend to put less in bonds because they can grow their money more quickly in the stock market. So bond rates tend to go up because they're trying to get people to buy bonds to compete with the stock market. Generally speaking, though, people put less money in bonds. Now, different ways we can invest. U.S. government savings bond. How many of you have ever had your grandparents give you a savings bond? It was a very traditional thing to do. It's a very safe investment because it's backed by the U.S. government. That's why the interest rate is so low, because it's so secure. Generally speaking, the riskier the investment, the higher the interest rate. So we get into other things. For example, Treasury notes, lending money to the U.S. Treasury, or the T-bill as well. Municipal bonds come down to, for example, if the city of Loretto, the town of Loretto, needed a new water system, they can issue a public bond, and you can invest in a municipality and lend them money to get, so they get infrastructure, you get money back in interest. It's the same as borrowing money. Here's some of the advantages, guys. If you borrow money, let's compare this to the stock market. If I own a company, Leroy and I both own companies. He issues stock, I issue a bond. Right now, is he compelled to pay anything back to you in the term of dividends? Is he required? No, he's not. If I took a bond, am I required to pay you guys back? Yeah, with interest, for sure. Now, here's the deal. You guys all have shares in Leroy's company. Who has the control of the company? Yes.
The people around us.
Yep, you got it. They basically have control because they own shares. If I borrow money from you guys, I can still do what I want with it because I borrowed the money. I got to pay it back, but you're not controlling my company. I can also deduct the interest on my bond as well. If I'm paying interest on this, it's tax deductible, where money that you make from the stock market actually costs you in taxes. And here's the other trick too. If you get what we call a callable bond, it means I can pay it back before the date is up and save some money on interest, but it has to be a callable bond. Those are all advantages. Well, here's things that are disadvantages. Yes, sir.
I got a question.
Yes.
If it's an employee-owned company, how does the stock work?
Interesting. Now, if you have a publicly, so they're issuing stock, or they, for example, you remember were you here when Earl came in from Sheets? Yeah, they issued stock, but they're not publicly traded. So technically they're an employee-owned company, but nobody outside the company can own that stock. So the way that works, essentially, the stock still appreciates in value as the company goes, but it's not publicly traded. If you're an employee-owned company, once you become publicly traded, you're not technically employee-owned anymore. If you're traded on a public exchange, you're owned by whoever owns the stock. So what Earl is saying was correct. If you don't have it listed on exchange, if it's issued to you as a term or condition of your employment and it appreciates based on investors, yeah, it's still technically public or privately held, but there are shares of stock. So that's an unusual situation because there aren't that many employee-owned companies at larger levels anymore. There's a few of them. Like, have you ever heard of Menasha Corporation? Menasha is one of the largest privately held companies in the United States. I think last year they did something like $5 billion in business, and they're still owned by a single family. Sheets, I forget what Earl said that they were doing, but it was billions as well. So there are those rare privately held companies, but most of the public ones, if it's publicly traded, it's not employee-owned, unless the employees buy all the shares. That makes sense? Yeah. Okay. Good question, though. Some of the disadvantages of issuing bonds, for example, anytime you got a debt hanging over your head, people say, wow, this guy owes people money. I've legally got to pay interest whenever I pay my loan. And also, by the time that the bond hits its maturity date, I got to pay it off, or I'm going to be, number one, I'm going to be refinancing. Number two, my credit rating is going to look terrible. And number three, people might be questioning whether or not they're going to lend me more money. Now, this is important, guys, in terms of how bonds are rated. There are three primary rating groups. These are finance companies that rate the quality of debt. So Moody's, Standard & Poor's, and Fitch. These are finance houses who will come in and assess a company or a government and be able to say, is this person, is this company, is this government a good risk or not? So if you've got AAA ratings, that means you are low risk. That means you're going to pay the least amount of interest when you're paying the debt back. Think about it this way. If you got a good credit rating, for example, and you go in for an auto loan, you're going to pay a higher or lower rate. This is important to know, guys. You guys will be buying cars sometimes. If you have good credit, let's say, for example, so Lewis and I are going for cars. He's got excellent credit rating. He's getting 0% financing. He's not going to pay any interest at all for 60 months. My credit's terrible. I'm going to be paying 12%. Who's paying more for the same car? I'm paying a lot more. And so it's the same deal when you're borrowing money for a company. So if you get into A, triple A, double A, single A, these are all good. Once you get down to double Bs and lower, that's what we call junk bonds. Those are incredibly good investments if you like risk because they have higher interest rates on them, but you might lose your ass as well if the debt, the person who is supposed to pay back their debt defaults on the loan. That's why you're paying more. So you get into like the C, A, C, C, and C territory. Those are very risky investments. Those are companies that are trying to hang on. Not a good place to be. So again, it all comes down to whatever your rating is. And again, remember this, anything that is double B or lower is considered to be a junk bond. With me so far, guys. All right, guys, I think what we're going to do here, because we have 5 minutes left, this is a good place on Valentine's Day to let you guys off the hook a little early. Before you leave, remember this, guys. When's our test? Next Wednesday. I sent the study guide an email this morning. Please study. We're going to be forming groups on Monday, so talk to the people you want to work with. Have a good weekend. And remember, there's 4 to 5.